is yet another environment where the conditions are pretty right. That combination of lots of global capital stuffed into U.S. market with a rate cutting cycle coming up. That's basically dry tinder that emerging markets potentially could take the baton from. The vicious or virtuous cycle that happens there is that a lot of emerging markets, kind of what defines them, is they have a lot of dollar-denominated debt. And it's not even mostly owed to the U.S. It's owed to China. It's owed to European lenders. Some of it's owed to the U.S. It's owed to all these different entities that lend in dollars. And whenever the dollar strengthens relative to their local currencies and cash flows, it's kind of like if you took out a mortgage in Swiss francs and then the Swiss franc doubled relative to the dollar. You'd be in trouble with the property of the value of your property and the cash flows that property can generate. You'd have trouble with your liabilities that just hardened. The same thing kind of happens to them, except it's the dollar that's going up. And then more capital wants to get out of there. When that's happening, it goes into the US, which then ironically strengthens the dollar further. And so you get this kind of vicious, so you get both a credit expansion or credit contraction component, and then you get that strength of that dollar relative to the other major currencies. And basically, if that goes up or down in a given 12-month period, Bitcoin has the highest likelihood of other assets to do the same direction, which is over 80% in Bitcoin's case. So I put a lot of that focusing on global liquidity when I'm thinking about, say, a 2-year or 12-month Bitcoin price. I don't really try to judge like month by month or quarter by quarter Bitcoin price. For the political component, obviously most Bitcoin conferences are not that political. This particular one that happened in Nashville it's the biggest one in the world, and it's during American election season. So this one was very political. I guess the interesting thing about it is that most of the headlines were the Republicans there. So obviously Trump was there. There are a number of senators and representatives that were there. But I think what went under the radar is that there were gains that is just an increase to the current capital gains. I think the market is kind of discounting that somewhat. I find both tales not productive in general. That'd be my take. I did like a 50-year analysis on how economy performs, how markets perform, how inflation performs under Republican or Democratic presidents. And it's more complicated than that because you'd have to incorporate the Senate and the House, and kind of the government's not just one entity. But in general, over those 50 plus years, the economy did better under Democratic presidents, and so did the U.S. stock market.
Stay with us. We're back with Prof G Markets.
It feels as if inflation has kind of come down to its sort of target level, or is fast approaching its target level. Is there a fear that it could crash through its target level and we could enter into stagflation or recession? When you look at the different barometers for inflation, what do you see?
Divergences between sectors. And so if you look at, for example, like in 2022, when many people were forecasting a recession, we did not get a National Bureau of Economic Research. Like they didn't define an official recession. But if you looked at, for example, the misery index, which is inflation plus unemployment, that reached recessionary levels. If you look at consumer sentiment, it reached almost record low recessionary levels. If you look at, and this is the interesting one, bank loan tightness. So if you look at, they do surveys of senior loan officers at banks, and they say, are you tightening credit standards or are you loosening credit standards? And almost always when they have a big tightening period, it's recessionary. And when they're loosening it, it's, at least in rate of change terms, like fewer of them are tightening, you're coming out of recession. And in 2022, we went through a classic bank credit tightening cycle that looked like recession on the bank, senior loan officer survey. It was like basically everything about that survey screamed recession. And we did not have right now everybody's focusing on the Mag 7. But for example, Costco is trading at like 55 times earnings. And it's a wonderful business. I mean, it's actually one of the few businesses that like shareholders, employees, and customers like. I mean, who doesn't like Costco? But it's I wouldn't pay 55 times earnings for it. When you look at the PEG ratio, so price to earnings to growth, it scores very poorly on those metrics. And it hasn't mattered yet. I mean, Coca-Cola has spent a very long time overvalued, and so did Walmart. And so it's actually, I think there's a bubble in some blue chip risk off names where everyone says this company's bulletproof, so I want to own it. And then the problem is maybe the company's bulletproof, but the stock might not be bulletproof. And ironically, I mean, Costco's trading at higher valuations than a lot of the Mag 7. You look at price to earnings or other kind of metrics like that.
That's crazy.
Yeah, higher valuation than Alphabet, higher valuation than Meta, higher valuation than Apple. Uh, it's it's one of the more expensive stocks out there. When you look at kind of traditional price to earnings.
But why are those three missing?
So Tesla, I'm not very bullish on fundamentally. Right now, their growth metrics are not great. I generally view them as structurally overvalued. Apple, less extreme case, but basically I would say it's a value stock, a very high quality value stock priced like a growth stock. So you pay, it's not like Costco, but you're paying pretty high valuations for a company that's it's a lot of the growth now is coming from a fairly static top line, and then they buy back their own shares, they adjust their price with inflation. Like you're kind of this like wide moat but slower growing entity now. Doesn't excite me. Meta is more borderline. I've been back and forth on that. There are periods of time where I've owned it. That one I'm kind of more neutral on. Like that could go either way for me. Whereas a lot of the other Mag 7, I think they have reasonable valuations relative to their current and expected growth rates.
Just one last question from me. For our listeners who are maybe just starting out investing, just about to build their portfolio, would you have if you could give one piece of advice to someone in that position, what would it be?
So the way that I approach portfolio in this environment is a 3-pillar portfolio. So it's like one big part, you can focus on everything else. I think the majority of people shouldn't be spending a ton of time on investing unless it is, again, unless they either love it or it's their way that they earn income.
Lyn Alden is a full-time investor, independent analyst, and the author of Broken Money, Why Our...
I'm wondering what you think of that and how you think about geographic risk in your portfolio.
Yeah, it just makes sense. My sense